Welcome back, traders. It's John. It's August 11th, 2023. Time for a general market update. I recorded this about 11:15 a.m. Eastern Standard Time. So as a reminder, here's the disclaimer. This is by Rain King LLC, and I'm an amateur individual growth stock investor. We have a lot to cover today. We're going to talk about the indices, the internals. Then we're going to get into a little bit more depth about institutions driving the market, then the importance of all-time highs versus 52-week highs. And then I did a little mini research project on history. So we'll look at how to follow the leader, and we'll summarize. So let's get into the indices. Really quick, just a quick update. The pullback continues. We're in our second week down. It's probably worth noting that so far, less volume this week than last week. Last week was a distribution week. Lighter volume is constructive on the pullback. And we also have the 2009, 2003 pullbacks as a guide. So this is the NASDAQ composite. We'll go through this quickly. I've marked here on the chart the 50 SMA in red, and then I've also put the 65-day exponential moving average in gray. And I'm going to talk a little bit of how to use this further in the video. But the NASDAQ has had 7 distribution days. That was our first clue that things were not right. We've been below the 20-day moving average for 3 days in a row. More than that, so it's actually the short-term trend is down. We're below the 50-day. And in addition to that, we've seen some of the leaders are cracking. Palo Alto, Supermicro, Palantir, etc. So we're definitely correcting here. The question is how deep it will go. The S&P right now is the stronger index at the moment. It has 4 distribution days, and we're still above the 50-day moving average. So let's dive into the internals quickly. This is the NASDAQ new high, new lows plotted separately as of last night. We want to look at really at the last 2 weeks. You can notice here that the new highs have actually really flattened out, and I've kind of drawn this yellow line at 50, and I've drawn it across, and you see we're back down to levels that we saw back in the spring, back in April and May. Now, probably a little more concerning is the pickup in the new lows. The new lows have been expanding, which is not what we want to see. Some of these levels we haven't seen since May. So when we have at least 3 net new lows, that's a concern. We've had 4. So this is not what we wanted to see. And you'll also notice that even the new highs that we got back in July, they were good, they were improving, but they're nowhere near a raging bull market. We would want to be over 300 per day to have something be looking like a real raging bull. So it's improving, but we haven't really gotten confirmation that this is a super bull. Now here's the New York Stock Exchange, same type of chart. You can see this is a little bit more constructive. The new lows are still fairly contained on the NYSE, but what's more important is we're still at net new highs. When you subtract the new lows from the new highs, we're still net positive, which is different than the NASDAQ, confirming that the S&P is the stronger index. Now I pulled up the XLE here, and I'm taking the XLE ETF, dividing it by XLK, which is technology. And you can see that this is the first time in 2023, the past month, energy is outperforming technology. And that's evidenced by the line is moving up. Energy is outperforming technology. Now, why is this important? Well, oil prices are rising, and oil prices are, they're a pretty dominant component to the CPI index and the producer price index. And oil is used in so many things across the economy globally, gasoline, building products, et cetera, et cetera. So oil prices are moving up. And the question is, with this potential to impact the CPI, how's the Fed going to react to all of this at the Jackson Hole meetings that are coming up in late August, as well as the September Fed meeting, where at the moment, the odds say they're going to hold interest rates, but that could change. There's a long time between now and then. They may even raise the rates one more time. It just creates a lot of uncertainty amid this very seasonally weak period for August and September. Now let's get into the institutions driving the market. Now, I've taken a slide here that I used in one of my most recent GMU extras that I called Shakeout or Get Out. You may want to rewatch that video, which is a 10 to 15-minute quick video about shakeouts. And in there, I shared that, retail traders have a different set of uses of tools versus institutions. And I circled here, retail traders tend to look at the 50-day simple moving average as a guide, as a sell guide or support guide. Now, I mentioned back then that the 65-day exponential moving average is what the institutions may use. Some use other ones, 68 exponential, 100-day exponential. So, this can change. In general, I think the 65 is a good gauge. Now, why am I showing you all this? Well, in that video, and again, I'd encourage you to go watch that video on my YouTube channel. I'm not going to go through this chart, but I break down of how institutions try to accumulate stock by inducing shakeouts. But the main concept here is once you have a stock in a range and it has support, a lot of retail traders put their stops in, and an institution will drive the price down in order to trigger all the stop loss orders, and then an institution will come back in and scoop up shares so they can increase their shares at lower prices. But the video goes into a lot more breakdown. I encourage you to go to watch that. Now, I'm showing that concept because as some of the leaders have come in, and I'm showing Tesla here, you can see Tesla has come down. The red line is the 50-day, and you can see Tesla's broken the 50-day, but I've also shown the 65 exponential, which Tesla was sitting right on potentially as support. And the 65-day I mentioned can be support. It's not obvious to the retail trader, usually knocks out a lot of weak hands on the break of the 50, and institutions sometimes will come in and support the stock, and you might get a shakeout. Here's MongoDB on the right. You'll notice that this is a very sharp decline, but it's come into the 65-day. Maybe it's getting a little bit of support. We'll have to see how it turns out. Now, there's no guarantee. It's possible that we don't get a shakeout, and Tesla and some of these stocks actually form a more of a multi-week basing process and dances along here for a while. So that's a possibility. There's also the possibility that the market really rolls over and breaks lower. So we don't want to rule out that possibility as well. So shakeouts, multi-week basis forming, or more declines ahead. We'll have to just observe these things as they happen, but we're at a pretty important juncture around the 65-day for some of these stocks. Now, I wanted to show another example. This is Celsius. And Celsius, right before its earnings report, you can see really shook down below the 50 and probably shook out a lot of retail traders. And you'll notice that it got support off the 65-day exponential, as well as some other support areas in the chart. Now, I will tell you, I had a position in Celsius and I got stopped out on this day right here by 5 cents. So it's unfortunate, but that's the way things go sometimes. Now you'll say, well, geez, this turned out to be a shakeout because we had a 20% gap up on earnings. So what did I do? Well, I bought the stock back. So we'll have to see how this turns out, but you can't be afraid to buy a stock back if you get shaken out. Now, NVIDIA, it's here on the left. NVIDIA had broken the 50, and I believe it's actually going further below the 50 today. So it's starting to come into the 65-day exponential, and I'm going to talk about NVIDIA in a little bit more detail in a few minutes. So looking at the leaders, again, this was last week's chart, and we're showing this progression week to week. Last week, we said there was more red and yellow on the chart, which was a concern. Now let's look at what's happening today. So again, I've moved the August 3rd table over here, and I've got the same table here for as of last night. Again, simply using the squint test, you can see that there's much more red and orange, yellowish colors on the table. So a couple things to note. This is sorted by the percent off 52-week high. So you can see here a lot more stocks are showing up and correcting more than 15%. And usually when you correct more than 15%, it usually means the stock needs a base in order to rebuild itself to have a next launching pad to move higher. So I've also marked in green, these are stocks that had improvements over the past week. You can take something like Celsius, which had a number of distribution days. You can see it actually has dried up quite a bit. Other stocks have improved their AD ratings, and a few have the relative strength lines improving. So the general picture here is the weakness amongst leaders has gotten more widespread. Now, earnings reactions have been really treacherous. This was the first week. This was last week. Here we are in the orange color here. The earnings reaction this week have been more of this situation where even though they have surprises, if the guidance is not great, you're getting gap downs. We had a gap down in SMCI. We had a couple of gap ups in Celsius and Duolingo, but generally the earnings reactions have been poor. In the next few weeks, though, we have a couple more important growth stock earnings reports. We have ON, PanW, as well as NVIDIA in 2 weeks. So let's shift to all-time highs versus 52-week new highs. So we talked about institutional accumulation. I wanted to point out the importance of all-time highs. And here's a cluster of 4 names. ELF, all-time highs were made back last September. Here's Veritas, which just made an all-time high coming on its earnings gap. NVIDIA made all-time highs way back in May and April. And Celsius has been making all-time highs since April. Now, the importance is when you have all-time highs, every tick higher, everyone who is long that stock is making money. There's very little, if any, resistance. There's some normal profit taking along the way, but there isn't a lot of sellers above you. There are no sellers above you. So these are some of the names that were making all-time highs, and that's really important. All-time highs are the strongest situation. And I think it was Nicholas Darvis would put in his book that he would only trade new all-time highs. Now, 52-week new highs are also very, very good, but they're not as good as all-time highs. So let's look at, there's a whole bunch of stocks here that have formed 52-week new highs, but not all-time highs. So here's Palantir. And then the point I want to try to make here is, though this is a 52-week new high in Palantir, the reason they're not as good is you have this thick overhead supply. There are all these people that bought in 2021 and some in 2022 that have losses on the stock. And as soon as it gets up into this level, they're going to be selling to try and break even. And you can see that's where resistance started with Palantir. Tesla, which has been a strong name in 2023, did not even make a 52-week new high. And there's a lot of choppy overhead supply ahead for this one. Airbnb, again, 52-week new high, but lots of thick overhead supply. You can see how long the stock chopped in this area. So it takes a while for that to clear out. MongoDB, very similar, a lot of overhead supply. So again, the point I'm trying to make here is that new highs are stronger situations than all-time highs. I know people get attracted by trying to pick stocks off the bottom, and that can work to a degree, but still, thick overhead supply can really be an impediment because there are all these trapped buyers that bought on the way down. Now I want to shift to follow the leader. Now, in this exercise, I did a little bit of historical research that I wanted to share with you. So let me set this up. This is NASDAQ. This is the NASDAQ composite, this orange line chart. And this is a weekly chart from 1994 to 2000. Now, below that, I've lined up Cisco. Cisco Systems was one of the biggest leading stocks in the 90s. So that's shown down here in green. So what I tried to do here is I wanted to look at how I could correlate what was happening in the NASDAQ and what was happening to the leader. So I've taken, when we had this long consolidation in 1994, finally the market broke out and launched a major bull market in 1995. So from 95 to 2000 was an incredible run, but there were corrections along the way. So I wanted to look at the corrections along the way and how did Cisco perform? So I looked at the 96 correction. There were 2 corrections in 97. So the first one, the second one. Then there was the 1998 bear market. And then we had the bull top in 2000. So these lines in the chart, all I'm trying to do is I'm trying to mark the NASDAQ's peak. So in this case, there's the NASDAQ peak, and I've drawn it all the way through to what Cisco was doing. The green line marks the bottom in the NASDAQ, and the blue line is when the NASDAQ composite eventually resumed to new high ground. And I've correlated that with the Cisco chart below. So let's look at this a little closer now on a daily. So this is a daily chart, and this is looking at that first correction in 1996. So what do we learn here? Well, here's where the NASDAQ peaked, this solid red line. Now the dotted red line is showing you where Cisco peaked. Cisco peaked a couple of days after the NASDAQ declined. Here's the bottom in the NASDAQ, and here is actually the bottom. About a week later, Cisco bottomed. Now what's important with this first correction, you can see here in blue, the NASDAQ did not reach a new high until October 15th of 96, but Cisco made its new high much faster than the index. Almost a month earlier, Cisco rebounded quicker. So I followed through this methodology with all those corrections that I mentioned. So here's the 96 correction, the 2 in 97, the 98 bear market, and the top in 2000. So the point I wanted to make is I wanted to look at Cisco relative to the NASDAQ. So we wanted to also look at it relative to new highs. Relative to the NASDAQ, how did Cisco perform? So you'll notice here that most of the time, Cisco was later to peak out than the NASDAQ. 1, 2, 4 to 5 times, the leader peaks out later than the index because it's such a strong stock leading the market. You can see here relative to the bottoms, most times it's showing here that Cisco bottomed literally on the same day as the NASDAQ. And then when we look at closing highs, we can see 3 out of 4 times Cisco systems bottomed and went to new highs before the NASDAQ got to new highs. So it's showing you relative strength. It's showing you that the leader, the alpha dog of the market, will return to new highs with this tennis ball action, quick to bounce back. Now you may say, John, why are you showing all this stuff from the 90s? Well, here's how I wanted to relate it. I wanted to look at this in relation to NVIDIA. NVIDIA is the leading stock in the market. It's the alpha dog right now. So again, here's the NASDAQ in orange at the top. And here we have NVIDIA chart. So as I mentioned in prior videos, NVIDIA had over 100% move since its last base toward the beginning of this year. And the stock moved into this $500 price level, a psychological level, and the stock is pausing. Now you can see here I've lined up the peak in the NASDAQ and NVIDIA. Now NVIDIA in this case peaked just a few days before the NASDAQ peaked here. Now on the chart, I've shown the 50 SMA at 429 and change. I've got the 65-day at 403 and change. And then I've also shown another psychological support level potentially for NVIDIA. That's the 1 trillion valuation that institutions are really keyed in on, because they're the ones who determine if NVIDIA is worth 1 trillion. That's at 409. So I've put all of these kind of markers here. We're below the 50. The 65-day may come into play as support, and then we have 409. It's possible that NVIDIA might get some support in these regions and start to base out. And the question is, NVIDIA, being the alpha dog, is reporting its earnings on August 23rd. And the question is, if this is a leading stock, can NVIDIA's earnings report lead us out of this correction, or does the report have a negative effect and the pullback goes much deeper? So we want to watch this carefully as it unfolds, similar to how you could have watched Cisco back in the 90s. So let's summarize. So the quick summary is the pullback continues. The recent debt downgrades have really led to bond yields rising. And it's creating a lot of pressure on growth stocks, particularly small caps. Now, there are a number of potential market movers, both up and down. So we want to keep our eye, as I mentioned, on the action of NVIDIA, and the Fed is meeting at Jackson Hole later this month, as well as September's Fed decision could be pretty important to the market. Earnings reaction continues to be very, very risky. A lot of uncertainty about guidance. You need cushion, and it's apparent that you need a lot of cushion going into earnings with some of these reactions. So it's probably a time to keep your powder dry on any new fresh buys. You only want to be selecting the strongest situations and strongest setups. And I mentioned all-time highs versus 52-week new highs. And we've been saying for over a month to stalk the leaders. Many of these leading stocks are pulling into support levels. So these could be potential new bases, which we could buy a leader, could be pullbacks that get support right off the 50 and 65-day exponential. And we want to watch them. It could be a way to find your way into a leader that maybe you missed the first time out of the gate. Now, it's important if you've gotten hit on one of these earnings gap down, you really need to regroup mentally. When you take a give back of profits or you take a sharp loss, it's better to sit out and regroup. Don't revenge trade, particularly as the market is pulling back. And we've shown you right now, the odds are the market is going lower at the moment. So exposure levels, I'd be dialing it back. We want to listen to the market feedback, and it's giving us feedback that we're pulling in. So don't try to fight that. I think exposure levels could be lowered a bit into the 30 to 50% range, depending on your cushion in different positions. So the quote of the week is from Bob Farrell, who was longtime senior analyst at Merrill Lynch. And his quote is, if everyone is waiting for a pullback to buy, either the market doesn't have a pullback, or if it does, you shouldn't buy into it. And the point is, the obvious seldom works in the market. Everyone's been anticipating this pullback. The question is, does the pullback go deeper in order to shake out hot money, shake out people that think it's only going to be a brief pullback? Well, that remains to be seen, but let's keep our eyes on the ball. So the Boston meetup is meeting on Tuesday, August 15th, 7 to 9 p.m. We're really looking forward to this chart talk. At TA Plot and myself will be breaking down a number of charts. If you want to register for this and get the recording, you have to register. Just go to our feeds and you'll see the registration link, or you can join the Boston meetup by following the instructions on this slide. I also wanted to put out a save the date. The Blue Sky event, and this is going to be our 6th year. I'm the founder of this event, and we do a all-day workshop virtually, and we're in our 6th year. We're really excited. It keeps growing every year. So the save the date I wanted to get on your calendars is Saturday, November 4th. We'll be announcing the speakers in a few weeks, and we've got an outstanding lineup of unique content to share with you. So this is just a reminder to try and save the date, and we'll announce when we can actually register for the conference. So that's the general market update for August 11th, 2023. And here's where you can find me. We'll see you on the next one.